Oh, thank you, everyone. Let's take it all the way down from the country's political capital, Abuja, where we just finished discussing the ERGP and part of the conversations of the communique of the central bank on Tuesday. So let's take it down to my street, the market street, and your street as well, in particular the fixed income space. And we go all the way straight to our studios, downtown Lagos at the Nigerian Stock Exchange, where Temple Ashaju, our business correspondent, is standing by with Jolomi Odongaro, who is an associate and a team lead for fixed income research at Afrinvest. Good morning, Jolomi. It's good to see you there, sitting down there with Temple Ashaju. Nice to have you. Welcome to the program.
Good morning. Thanks for having me.
Yeah, it's good to have two of you there. But let me just shoot the first one directly to you. What do you make of the MPC communique yesterday? What is in it for the debt market? And after that, Temple will take it away from here.
Okay. I was on a couple of weeks ago and we spoke on the same subject, and our point of view back then was that there would be no need to change any policy variables, and that's what happened. So what we've seen in recent times is that the CBN has been able to deploy other monetary policy tools to affect yields without necessarily having to adjust the monetary policy rate. So that is why we believe there was no incentive to move the rate at all. And so what we're going to see from the debt market, or what we've seen over the past couple of weeks. So over the last couple of weeks, we've been seeing basically an upward movement in the yield curve on bonds, while T-bill yields have trended downwards. The expectation is simple. Investors expect that going towards Q4 and going towards the election, what you're going to find is that yields will go upwards because of the need to tighten to reduce, to stem the capital flow reversals that will be happening over the period for two major reasons. Number one would be increased political and policy risk that international investors are wary of. And the second is that as you have policy normalization in the US and the UK, what you find is that the interest rate differential is shrinking, and that disincentivizes external yield-seeking behavior. So what you're going to have is that yields should trend upwards towards the later part of the year. So investors are more likely to go short now so that they can take advantage of, or they have money maturing later on in the year when they can take advantage of the higher yield environment.
Okay, I'm going to let Temple take it a bit further. But then just a very quick one. Jolomi, what liquidity and risk factors do you think we face right now? We can't keep investors always happy. There's a price to that. If you look at Egypt right now, it's paying a price for keeping investors happy. So, and we are paying some price. Do you think we have what it takes to keep paying this price?
At the moment we do. So as long as the overarching objective of the central bank is going to be price stability. So as long as that's the case, what you have to do is that you have to keep capital flow reversals stemmed. That's the truth, to reduce the pressure on the foreign reserves and pressure on the currency. So now with oil at crude oil prices at the $82 levels, I said yesterday, what you find is that accretion to the reserves should be strong, but at the same time, there is still quite a bit of demand for dollar for portfolio investors, and that's what has been putting pressure on the reserves over the past couple of weeks. Reserve levels are now at about 44.6 billion, from a high of 45, from about 2.4% down month on month. So I mean, for now, the overarching objective will continue to play out, and what you're going to find is that tightening is necessary, and investors will remain happy over the short to medium term.
Temple Ashaju, who is sitting there in the studios to take it away from here. Temple, fire on.
I already did. Well, one of the key parts of this conversation for me is the fact that yesterday, when the rates were left unchanged, the debt markets came back totally flat, the bonds and the treasury bills. What would you say that decision actually meant for the debt market?
So basically, it's priced in as of now. So no one is really expecting an upward revision in the MPR, and the only other thing that can really affect the market either way is if there's an inflation shock. And given that the base effect is gone, everyone is sort of priced that in as well. So we're going to have a little bit upward hike in inflation going forward. That's priced in. If that's priced in, the only other thing for the market to really be concerned with is if there's a policy reversion, and there wasn't, and the market expected that. So that's why you saw what you did. Yes, it was flattish, but there was movement on the bonds and the T-bills. Like I said, investors are moving to the short end as opposed to the longer end. Yeah, exactly. As yields move forward, you will see that dynamic change. Yeah.
Yeah, because again, the 2027s, 2020, whatever you have, all were basically seeing much of expansion yesterday. So in terms of liquidity risk, in recent times, we've seen much of elevated liquidity in the system. You got people being able to reinvest. Do you think this decision will be able to help sustain things in terms of liquidity going forward?
No, at the end of the day, the CBN would have to look at that because excess liquidity in the system has a way of increasing speculation on the dollar, which is not something that they would like to see happen. So this is a short-term thing. You have the bond auction today. That should drain a little bit of the liquidity. I'm sure there'll be a normal later on in the week as well, yeah, which will reduce the liquidity in the system. And we expect to see that sort of this sort of increased operation going towards the full year, especially as you have pre-election spending and the impact that can have on the inflation level. So definitely M2 growth, so money supply should come down going towards Q4, the end of Q4.
But on this liquidity, I see it still being around the corner because, again, as we speak today, you should have maturity of some $860 million US at the FMDQ OTC. Will that change anything?
No, like I said, it's what you find is that as money comes out, as there's maturities, there's typically either an open market operation or a primary market auction that takes the liquidity back out of the system. And it's not going to be more than a couple of days, to be honest, for it. So the impact on the market will not be significant.
So what will be your expectation for the auction today? Some 90 billion naira to be auctioned by the debt management office, 25, and then 40 billion naira. How much of moderation are you anticipating, or you think?
Not a moderation per se, because at the end of the day, what the yield curve is telling me that is investors want higher yields on longer term instruments, and I expect to see a hike in those yields because at the end of the day, we all investors that are going to bid at those yields, and then whatever clears the market is where the yield is going to end. And so I expect investors to want to seek higher yields than we even have in the secondary market at the moment. I still expect 10 to 20 basis points higher than the secondary market level, which is an indication of the movement upwards at the long end of the curve.
So the amount being offered today is really is relatively small, 90 billion naira, compared to what is being done, I mean, way back. You think we still have headroom for more increase in yields?
Yes, definitely. Definitely.
And you think federal government will be able to sustain that?
It's a short-term thing, so there is a need for tightening, and it's almost inevitable. So we expect to see that going towards the end of the year, yes.
So what external factors should we be then watching as related to this issue of the debt markets going forward?
Yeah, the most important of all of that is what I mentioned earlier, policy normalization in the US Fed and the BOE, Bank of England. So we expect about a 25 basis points hike at the meeting this week as well, of the US Fed. And that has an impact on the yield differential between the countries. And that has a further impact on capital flow reversals or even investments into the country long term, especially given that our yields have basically not moved over a little while. So, I mean, the most important is that factor. Then, like I mentioned earlier as well, the political risk is something that we think is going to push investors to let's delay investing in the country, and that's till February next year. And so those right now are the two factors that are most important. Not to say that they're all the factors, but the most important, yes.
So one other concern will be the fact that this is increasing borrowing costs for the nation, for this administration. I mean, it's election time, and then you're going to be having that being capitalized on by a whole lot of opponents and all of that. And it worries not just the politicians, but the worry to the investors as well.
Yes, I mean, at the end of the day, it's a short-term pain for the gain or the benefit of price stability. That is, like I've said multiple times in the show, the overarching aim of the central bank, and it's a short-term pressure, and so the DMO will issue at higher yields on the bonds because it's necessary.
So for some other analysts, the argument's been that for the second half of the year, a kind of a hike in MPR is really anticipated. Is that the same thing for you?
No, what we've seen is that the central bank has been able to deploy other monetary policy tools to affect the yield environment and to keep the yield environment attractive internally and externally. We don't see a need to hike the yield, especially given the negative impact that it will have on growth long term, because that yield hike passes to the real economy much quicker than it would pass to the fixed income markets, which would be the incentive to do that. So we don't see a situation where they would hike the yield. It's just not something we're looking at, and it's played out for quite a while.
But in your opinion, how would you rate or assess the decision of the CBN MPC from the last meeting, where a bit of a quantitative easing was actually introduced into the system?
I mean, you're speaking of the
commercial papers, the RSSF, the CRR lending and all that, within that period, between then and now.
I mean, the RSSF, it's the incentive of the the aim of the RSSF is to boost real sector growth, given that the MPR cannot be moved at this time. And so you have the situation where it's not gained any traction as of yet. This is still something
because we really haven't seen much of flotations since then.
Yeah.
Thank you so much, Jolomi, for your attention. Back to you now, Bolson.
Temple, just a quick question before we let Jolomi go. Jolomi, I'm sure you can still hear me. When do you think we can have what you call a normalization of our own environment here in Nigeria in terms of interest rate, yield coming to perhaps maybe the top end of a single digit? We need a bit of normalization. This is not normal situation where we are in right now.
Okay. The truth is that normalization is unfortunately going to have to be long term for us, because at the end of the day, the structure of the economy requires this sort of yield level or monetary or policy rate level because of the need to attract foreign investments as part of the measures to control the exchange rate level.
Thank you very much.
So I would say
associate at Afinvest, the team lead for fixed income research. Let's come back to you after the break. This is Your Business Morning.